So thank y'all for joining us today. It is 1 o'clock, so we want to go ahead and get started, make sure that we are cognizant of you all's time here. Know y'all are really busy running businesses, owning businesses, so want to get this taken care of for y'all pretty quickly. So to introduce myself, I am Katie Galan. I am the Director of Education and Community Engagement for BBB Serving the Heart of Texas. I take care of the Coastal Bend region. I am based in Corpus Christi, but I know we're going to have people here who are all across our entire Serving the Heart of Texas service area, which encompasses 105 counties. So even if I am not the director in your area, please feel free to reach out to me. We don't have enough to have a presence in every single region, so we kind of all share that responsibility. So if you guys need anything, please feel free to reach out. I'm more than happy to help. I just went ahead and put my information there in the chat, my email and my cell phone number. Feel free to give me a call or text me. So thank y'all for joining us today. So if you are new here, if y'all haven't been a part of our webinar series, we offer these webinars every single month. They're always free of charge. Always like to try to keep it consistent, and always like to do the last Thursday of the month from 1 to 2 p.m. and try to really stick to that schedule for y'all. So we always have a lot of different topics that are business relevant, that are timely for you. We've talked about AI, we've talked about taxes in the past. We're going to talk about that today. Marketing, HR, all kinds of stuff that we hope will be really great tools to help y'all in your business needs. So today we're going to be talking to Shalini, but I want to remind you guys that the webinar for August is going to be on business, or kind of how to shift your kind of your business mindset to the changing marketplace, and how to adjust to those shifts that we're seeing. So I don't know if it's live on our website yet, but it should be pretty soon on our events page, bbb.org. And then of course you guys will probably get an email with that information as well. But today we are speaking with Shalini Kodiyak, CPA. And she owns her own CPA firm. She has over 15 years of experience in advising businesses on financial, all aspects of kind of your financial needs. So today we're going to focus on building. Of course, the title of this, Building Strong Financial Foundations for Your Business. We're going to talk about filing your taxes, how to track your expenses and avoid those compliance issues. Really, really important. And the different business structures and how that's going to affect your tax burden. So really great, pertinent information. You guys, of course, are muted, cameras off, but any questions or comments that y'all have, please put them in the chat section, and we will have Shalini get to those at the end of the presentation. So really glad that you guys are here, and now I'm going to hand it over to you, Shalini.
Thank you so much for the introduction, Katie. Thank you everyone for joining the webinar. I understand it's really time sensitive, and especially with the new tax bill, the one big beautiful bill that's out there, and a lot of business owners are wondering if it's more favorable for them or not favorable for them. So I'm going to go over a lot of things today, especially your estimated tax payments, which business structure is best for you, and also the new bill that and answer questions as well at the end of the webinar. And I want to give a small disclaimer that this webinar is for educational purpose only. Your tax situation is independent in nature. One tax situation is not similar to other, right? So it's not one size fits all. So always get your tax assessment done by your tax professional. Always choose your professional wisely. She or he needs to be a CPA or an IRS enroll agent, or someone who is a tax strategist and know all the tax codes inside out. So welcome to today's webinar, Understanding Which Business Structure is Best for You. A little bit about me. I am a founder and CEO of my firm, Shalini Kodiyak CPA LLC. I have over 15 years of experience, enroll agent, certified tax code, and a proud mom. I'm serving close to 350 business owners in Dallas area. I do have clients all over the United States, but my majority clients are based in Texas. So I want to explain what this unique situation you are in, right? You could be an entrepreneur, a restaurant owner, doctor, and I saw someone in a real estate business too. You could be a franchisee owner, right? Who's either starting, growing, adding on more partners or adding on more equity, raising capital, buying assets, leveraging assets, and selling assets, or needing legal protection, right? You could be any of these categories, right? And we want to go over like, the basics, right? Whenever we create an entity, right, we want to make sure that we not only follow the rules, but we also be compliant from the federal and the state side, right? I come across a lot of business owners who are considered as sole proprietor with no LLC structure, and they have no clue about the tax liability, and they are stuck with either the lawsuit or a vendor suing them, and they have no legal protection. So whenever you start a business or you are in current business, please identify if it's a hobby or if it's a genuine business. If it's a hobby, IRS will classify you in a hobby loss rules, right? That you are not in a business to make profit, but you're just showing losses on your tax return just to get tax advantage, right? So it could be considered as a tax evasion. So be careful that if you are in a serious business, your legal structure is really, really important. And the legal structure comes along with what state your business is incorporated in, right? I'm going to talk mainly about Texas because I'm a Texas CPA. But I do have clients in Delaware, Illinois, California, Vegas, Florida, that I help with business structure as well. So I personally think that if you are in a if you are in a business, you need a legal entity. Legal entity is really important, right? Because it will protect your personal assets. Well, tax deductions, be it a sole proprietor or a LLC, it's more or less the same, right? But the process may seem cumbersome because each jurisdiction, each state have its own requirement. But before you even get to that point, you need to identify, are you in a product-based business or are you in a service model business, right? And in Texas, right, services are not taxable, but if you're selling products, you need to collect tax from your customer and remit to the government. And that's really important. Your Texas franchisee filing reporting needs to be done by May 15th of every year. And then you really need to be concerned about the sales tax requirement because state and IRS do place heavy penalties. I recently resolved a case with Texas State in an audit where the client ended up paying $50K in penalty because he was not even aware of his sales tax situation. He had economic nexus in other states as well, where I ended up filing for permit and getting the sales tax filed for him. So this is serious, right? And these are the type of entities that I want to cover with you all. First is sole proprietor. It could be sole proprietor and journal partnerships are something you really don't need a legal structure, right? Like, let's say tomorrow I think of, oh, I'm gonna sell artwork, right? I'll just come up with clients and then start selling them, go to local shopkeepers or networking events and start selling my stuff. There is no legal protection. You and the business are the same. So you're considered a sole proprietor. Now, sole proprietor are usually taxed on Schedule C. So you really need to go over your tax return and see what your tax returns, say about you and your business. 1040 is the tax return for residents, right? And on 1040, there is a form called Schedule C, profit and loss from business, right? If you are in a farming business, you'll have Schedule F. So Schedule C are for sole proprietors. Even I've seen Schedule C with LLC structure as well, and I'll go over it in a bit. But sole proprietor and journal partnerships are the same. There are no structure. They share the risk. The personal assets are risk. And LLC is a structure where it is a limited liability protection, but it covers your assets, right? If I have an issue with your business, right, and if I want to sue you, I will sue the LLC and not come after your personal assets. I hear from a lot of clients, saying that, oh, we see on TikTok that LLC is a tax saving strategy. Well, no, it's a myth. LLC is not a tax saving strategy. LLC is a legal entity, right? It protects you, in case of lawsuit or in case of a vendor dispute. It protects your personal assets, right? And then there are corporations. Now in LLC also, like I've seen clients electing S corporation. Now S corporation has its own compliances, and most of the strategies or bookkeepers out there, they're not covering the compliances on YouTube or TikTok, because I get a lot of clients saying that, oh, we asked ChatGPT about this, or we saw this on TikTok or YouTube. And when I do their tax assessments, I come up with things that they were not even aware of. So S corporation, it's a tax entity, right? Because in the eye of IRS, your LLC is a disregarded entity, right? Just like sole proprietor, you have a LLC structure and you report your income and expenses on Schedule C of your 1040. Okay. So a corporation is C corporation, which is double taxation. It is not recommended for small to medium business owners who are residents of United States, and their shareholders are also residents of United States. C corps are best recommended for those who are looking to raise capital, who would have a different, who would have a variety of stocks like preferred or common stocks, and their goal is to raise capital from, internationally, like from other countries. Their structure is completely different. Like you need to have your corporate bylaws in place. There is a strong limitation of personal liability. C corp pays its own tax. It's not a pass-through entity. But most of my clients, like almost 70% of my clients, fall in partnership structure or LLC, single member LLC, or S corporation, where they'll have multiple shareholders, and mostly pass through. So pass through are really fairly easy, because when you get a K1 from pass through, it goes on your 1040 and you pay tax on the 1040. The LLC itself or S corp itself does not pay any tax. It's the C corporation that pays its tax. And if you are currently an S corp and you are not making minimum 50K in profits, I would suggest getting a revision done on your LLC structure, because S corp comes with its own compliance of a reasonable compensation study. You must have an accountable plan in place. You should track your bases. And there are a lot of things that people don't talk about in S corporation. So I am not a big fan of S corporation until or unless I understand my client goals and what they're trying to achieve out of the S corporation structure. The logistics are very simple. If you are about to start a business, you can pick a name and make sure it's available. You can do a Texas entity search and then see if the name that you're trying to pick for your company is out there, it's available. Okay. You can pick a name and then decide who owns what and who is doing what, right? You have to figure out who's providing the administrative work of the entity, who is a passive manager or an active manager, or what are your roles and responsibilities in the company. Address, if you are not comfortable with disclosing your primary residence, you can have a virtual mailbox. You can have a registered agent address to be listed when you incorporate your entity. Paperwork, it's really simple. For Texas, you just file your corporation documents. You have operating bylaws. If you have multiple partners in your entity, for single member LLC, you need to pick a registered agent. You can be your own registered agent. I would highly recommend, if you are in Texas and you have your own businesses, you should be your own registered agent, because you want to make sure that any legal document or any state or IRS notices come directly to you and not to your registered agent. I have come across with clients who have incorporated the entities with LegalZoom or other third-party platforms out there, and they have not received the notices that they received, but the LegalZoom received or other third parties received, because they just that's how they work. So I always recommend my clients that if you're local, you should be your own registered agent, and you can have a mailbox if you don't want to disclose your primary residence. Taxation. So I just discussed the sole proprietor, journal partnerships, the business deductions are allowed, and tax rate is your personal tax rate. Now, if you look at your personal tax return, there are two brackets of taxation that you really need to look at: your effective tax rate and your marginal rate, right? And I'll go over it in a bit. I don't want to overwhelm you all with jargon, so I'll keep it as simple as possible. So when you are a sole proprietor, your Schedule C, right? The income and expenses are reported on your Schedule C. If you are profitable, make sure your tax professional is giving you all the deductions, right? Your home office deduction, your auto mileage, and if you have purchased any assets, make sure they are also incorporating any tax planning and all the strategies that are available for LLCs, as corporation and partnerships and other entities as well, right? And then what it would do is, when you have your net income, you will pay self-employment tax because you are not paying yourself a wage. And I've come across with a return recently, Schedule C, paid wage. That's a big red flag, because Schedule C, when you're a sole proprietor, your net income, you're already paying self-employment tax on your return, right? So you do not have to pay a W-2 to yourself from your C Corp, from your LLC, from your Schedule C on 1040, okay? And then LLC to S Corp election is really simple. If you are making minimum 50K and you are a single member LLC, you don't have a complex business structure, your corporate bylaws are pretty straightforward, you can choose to elect S corporation by filing form number 2553. So the process is very, very simple. You complete the form, submit it to IRS. IRS will respond back with approval as on the effective date that you mentioned on the form itself. Now, what would S Corp do? S Corp will only and only save you from self-employment taxes. You'll save up to 15.3%. But you need to pay yourself a reasonable compensation reasonable compensation. Now, how would you come up with a reasonable compensation is another question, right? So what I do is I run the reasonable compensation study for my clients and making sure that they are not understating the wages or overstating the wages. Okay, and also look at all the tax strategies to reduce your tax liability. Requirement for taxes: your business income and expenses are reported on Schedule C and K1 from partnership and flow through your 1040. Pass-throughs, again, that you will get a K1 and it will report on your 1040. C Corps are not pass-through, so you'll calculate your capital gain loss when you sell shares, and it's double taxation. C Corps are not recommended for those who are resident of United States, who don't have complex structures, and who are not looking to raise funds or have foreign investors in the entity. I've seen C corporation in mainly tech companies, that I'm currently supporting. They have Delaware Corp, and they have complex structures, they have complex structures with multiple shareholders from all over the world. Yes, C Corp is best suited for those companies. Now, I'm not sure if anyone here is a nonprofit or running a nonprofit organization or being a representative of a nonprofit. Nonprofit itself, I've done quite audits for nonprofit, and I've come up with the organizational structure. Again, the big mistakes that I have found in nonprofit, where the mission and name is fine, but the board of directors, nonprofit need to have unrelated parties as board of director. If you're husband, wife, you cannot be on the board for a nonprofit. It has to be incorporated in your state. You need to apply for EIN, apply for 501c status, registered with your state agencies, because your state needs to know that you are a nonprofit, because they're going to audit. IRS and state always audit nonprofits. Set up the governance. You need to create your bylaws, conflict of interest policies, and hold initial board meetings. And it's the same with S corporation. When you are representing your company as a corporation, you are required to have minimum 2 board meetings in a year. And that's mandate, and also develop a fundraising plan in your nonprofit. See how your grants, donation, and events need to be classified in your chart of accounts. And it all falls to your accounting. your basis of accounting, and your basis of accounting is your chart of account, right? Your chart of account really need to define the industry standard codes. If you're a restaurant owner, right, your revenue, your COGS, your controllable and non-controllable expenses need to be displayed in your profit and loss really well. Same with nonprofits. Your donations, your grants, your events need to be classified differently in your chart of account. You cannot mix everything in one, right? Because there are unrestricted and unrestricted and restricted grants, right? And the P&L for each grant needs to display the correct numbers. So your chart of accounts, think about it like it's your base. If I want to understand your business, I will look at your chart of accounts, that if they are done properly, most of the time that I have come across, is that the chart of accounts are, already messed up. There are no line item for COGS, the cost of goods sold. There is no line item for revenue. It's all categorized. All the deposits are categorized as income. The expenses are like, all over the places. So I really want you to deep dive into your chart of accounts and the GAAP standards for your chart of accounts. If you're doing accounting for yourself, you need to understand which expenses are allowable by IRS and which are not. And there is a very useful guide on IRS. It's called Small Business Owner Guide. Please look at that. It talks about the record keeping and how you can maintain your books and what are the things that are required if you get audited. Because IRS already knows that you're understating or overstating expenses. Because if you are in a restaurant, let's say you're in a restaurant industry, right? And you're overstating your COGS, right, by 150%. IRS will know that you are, understating your expenses, right? So making sure that your chart of accounts talk to your industry standards, really important. Another situation I came across recently was the real estate professional, where he was a passive investor. He does not qualify as a real estate professional, but he was told that he was a real estate professional, right? So when I do the assessment and I look at the codes, the PLR, the private letter ruling, I look at the tax codes and then advise my clients on the real estate professional status. You have to put minimum of 750 hours in your real estate activity. If you have a job, a full-time job where you're getting a W-2 and it is non-real estate activity, it's very hard to prove or back up in case of audit that how you are putting more than 50% of your personal services towards the real estate activity, right? So, and every industry comes up with its own chart, right? So always make sure that if you're maintaining your accounting in QuickBooks, the QuickBook itself has industry standard charts. You can always ask ChatGPT or Google or talk to a professional about your chart of accounts, right? And making sure that your P&L and your balance sheet, they both are reconciled. And because they are your really important documents in case of loan. When you're looking for loan from bank, the first document bank asks is your financials, right? So your financials is the core of your business, and you really need to make sure that your basis of financial, cash basis, accrual basis, right? If you have a lot of AR and AP, account receivables or payables. Now, account receivables are customers, where customers owe money to you, right? So your account receivable needs to be on accrual basis. It cannot be on cash basis, right? Where a cash basis business is that you're recognizing income and expenses. You're recognizing income when it's earned, and you're recognizing expenses when it's paid. So that's where your cash basis book of accounting come into play. Accrual basis book of accounting is where your income is earned, but it's accrued, like it's not paid yet, right? So you're showing it as a receivable on your books. That's where your accrual basis of accounting comes into play. So again, it all boils down to your accounting, okay? And I also want to explain one last thing about accounting. Nowadays, with AI coming into picture, a lot of things are pretty much streamlined. Talk about expenses. I mean, you can download apps like RAMP, R-A-M-P, Expensify. You can take a picture of an invoice and just categorize it to the right chart of account and upload, and it seamlessly syncs to the QuickBooks. So expense management is really simplified. Invoices, most of the time my clients raise invoices from QuickBooks themselves. So invoices is where your AR can be tracked really well. And if you're not raising invoices, it's fine. Or as long as you know that if your books are set up on cash or accrual basis, and that's how you're categorizing your book of business. Now, getting back to nonprofit, sorry, I got off track, but I wanted to cover that as well. So Texas law for nonprofit are, in Texas, nonprofit are not required by state law to undergo an annual audit solely based on their revenue. However, they must maintain accurate financial records in accordance with generally accepted accounting principles and prepare or approve an annual financial report that conforms to American Institute of Certified Public Accountant standards. So in Texas, I've seen like the nonprofits need to maintain financial statements that complies with GAAP rules, and your board of director meetings, your internal controls need to be in place, so that in case of an audit, you have your controls in place, and you can justify your tax situation in front of IRS. Bookkeeping tips, I've covered most of it already, but I would like to go over it really quick. Sole proprietor, separate business, or personal expenses. Again, one very important tip that I give to my clients is keep your personal and business separate. Do not combine them together. Your business expenses need to be paid from your business credit card or debit card. And if your business doesn't have money to pay for the expenses, you do a capital contribution to your business, right? And when you take money out of your business, that's your draw, right? So really it boils down to how you're categorizing those transactions and what is the right course of action in case of keeping them separate, right? Your business and personal need to be separated from day one. Now, if you don't have LLC, you're a sole proprietor, please make sure to keep track of your income and expenses in an Excel worksheet so that you have the backup of all the invoices, the deposits, and also your expenses, right? Sole proprietor, general partnership, usually sole proprietor file Schedule C on 1040. Very simple structure. They track their receipts. Partnership, 1065, maintain their capital accounts, because in case of partnership, especially when you have unrelated partners, I've seen conflict of interest where one partner, is still taking losses when he's not supposed to. So look at your partnership agreements, right? And I've come up with a case where there were 3 partners. Only partner A was putting money in the business, and the business was not profitable at all, but the losses were distributed all across 3 partners. That was not right. So when I did the return, I amended the return because it was done by somebody else. So I amended the return and gave the full loss to partner A, because he's the one who's putting the money, so he should be taking full loss on his 1040. The other 2 partners did not get the loss, but their corporate bylaws, like the operating agreement, said that partners need to divide profit and loss equally. Well, IRS have a special allocation in this case where only partner A or first partner is contributing, or any partner is contributing more than the other partner. You can do a special allocation and it is allowed. But always look at the partnership agreements and clearly document what your capital contribution and profit loss sharing would look like. LLC, separate bank account. Again, you need to track your member draws, record expenses by category, and you can choose your tax treatment as LLC, sole proprietor, Schedule C, partnership, 1065, corporation, 1120. So now it comes to S corporation. And when you're a S corporation, you have to run payroll. If you are a shareholder, you're actively involved in the business, you're managing your business, you need to pay yourself a reasonable compensation. There are multiple ways to look at reasonable compensation. There is a US labor statistics. We run the RC report, reasonable compensation report, directly, and I get the chart for multiple standards to kind of combine what should be the right amount to pay to an owner. Track owner draws, because you cannot take more money than you put in. So you need to have a basis in the business to take draws. Yes, the draws are tax-free because you have paid yourself a reasonable compensation. Just think about, if you've made 100K in business, you're paying yourself 60K and taking 40K as a draw, which is a tax-free draw. But you have to be compliant. The reasonable compensation that you're paying yourself at 60K need to be compliant to the standards that are recommended. Maintain corporate records. You need to have your board meetings and have a minute of meetings. So always keep accurate salary and the distribution records, because that is helpful in tracking your bases. And if you look at your bases, right, your tax professional is not responsible to track your bases. I track bases for my clients because that's how I am. I want to make sure my client understand the bases, and I track it every year for them. But I tell my clients that you should know what you're putting in, how much income you have made, and what is your ending basis in the business. C corporation is a double entry accounting. You track your retained earning and you file Form 1120. Again, it's more complex and it's double taxation. So really need to be, careful for compliance and tax efficiency. Nonprofit income, you track income by donor or grant. You categorize income or expenses by the program, admin, or fundraising categories, and you file Form 990. Now there are other forms as well, 990 Easy and 990N, and there are certain requirements or thresholds, right? Revenue or grant thresholds in there that you need to look into, but you really need to be compliant with your grant restriction and donor intent. Tax compliance and strategies. Again, sole proprietor, you can maximize deductions using home office deduction. If you have a home office and your physical office, and you're still working from home and using your physical office as well, yes, you can take a portion of your home office and write off on your 1040 on your Schedule C. Mileage, track your mileage. MileIQ is a great app. I use MileIQ because I just have one card that I use for personal and business. So MileIQ, or there are other mileage apps as well that you can use, and you can track your mileage really seamlessly. Partnership, need to clearly document your profit sharing agreements, and you can deduct guaranteed payments. Now, when you're a partner, you are not allowed to pay yourself a wage. So no W-2s to partners. Please make sure that you are compliant, because IRS would not wait to penalize you, right? Because IRS thinks that you already know the codes. There is a Bible out there, that's irs.gov. That's my tax guide, and everything is out there, right, on the irs.gov. So yeah, they will, if they see that you're a partner and you're paying yourself a wage, they're gonna recategorize as guaranteed payments or draw. And then you pay penalty, interest, and whatnot. So be careful on the compliance. My goal is to make my clients more compliant rather than giving them all these strategies, because anyone can provide the strategies to you, but you really need someone who can help you with, in case of an audit, create a very strong work paper for you, and also guide you on the compliance side, that if it's really important to get that strategy, or you can get away with something else, right? So really work with someone who keeps your best interest in mind and not theirs. C Corp, again, C Corp file 1120, their corporate tax on profit. You can reinvest the profit. You can use fringe benefits to reduce your taxable income. So C Corp also has its own tax strategies. As corporation, pay your minimum, pay your reasonable salary, have an accountable plan. Now, what is an accountable plan? Accountable plan is a document that an employer creates for employees, where the employees pay out-of-pocket expense and the company reimburse the employee through an accountable plan, right? So if I incurred, an expense of $100, I submit the expense to my company and then they reimburse me back. Like for home office deduction, for mileage, right? You want to make sure that you're submitting your expenses to your employer. Now, if you are an employer and employee of your company, that means that you're one, you're a shareholder, or the single member LLC, where you are a manager, you're the only person, but your role is as an employer and employee. Make sure that you still submit your expenses to the company, to your LLC, and get reimbursements. It could be done either monthly, quarterly. I would suggest, monthly, but I've seen clients paying themselves quarterly as well. Nonprofits, they just track, making sure that nonprofit tracks unrelated business income, because there is a tax on it, and the grant or donor stay compliant. And yeah, so business structures can definitely help protect your personal assets, reduce your tax liability, and it also require good record keeping and documentation. I would like to show some things on the IRS website. Just allow me a moment. Let me share my screen again, and then I'll take Q&A. Sure. Well, first thing I want to show is the estimated tax payment. Now, the estimated tax payment is where, if you have earned income, right, in each quarter, and you're a business owner, you have earned income, you need to submit your estimated tax payments by these due dates, right? The due dates changes every year. So for 2025, right now we are in end of July, right? So whatever you've earned from June to August, right, you have to submit it by September 15. If you have missed your estimated tax payments, please make your estimated tax payments, because you will get penalized at the end of the year. Now, I don't know if you have seen your 1040 page 2. There is a penalty number as well on your tax return. Now, you can avoid that. And I've saved almost 10,000 in penalties by just correcting estimated tax payments for my clients. And I'll share this guide with you that just walks over what your compliances are for each month, right? And I'll share it with you, since we have very less time. I'll share this, and then I wanted to talk about the new bill, right? The changes in the new bill, the one big beautiful bill. Now, there are really good things in respect to bonus depreciation. Now, if you're planning to buy assets or vehicle, 100% bonus depreciation is now permanent. Earlier, the prior law was 40%. Now you can get 100%. Again, it's a matter of planning, who's doing your tax planning, and how they're spreading the expenses on the tax return. You don't want to get the entire effect on day one. You really need to be conservative. Now, when I do tax planning, and I'll share an example of a tax planning client. When I do tax planning, I look at I understand the goals. I look at their the risk factor, and then plan taxes. R&D expenses, again, earlier R&D was like, domestic expenses used to be amortized and capitalized over 5 years, and if you had foreign expenses, 15 years. But now it's full expensing for domestic, which is great. Like, you can write off if you're in a high taxable income for this year. So I'll share this as well, and I'll go over something cap. So SALT, SALT, there was $10,000 cap in the old law and the new law cap about 40,000. Now, if you look at your itemized deductions, your property tax, right, there was a cap at 10,000, right? But now the cap increased to 40,000, but it does phase out if you are a high income earner making more than 500K. Again, section 179 is, where earlier was 1 million expensing limit. Now it bumped up to 2.5 million expensing limit. And then the PTET, the pass-through entity tax, earlier it was capped at 10K, but now you can deduct the state taxes at the entity level as well. Now, Texas doesn't have income state tax, but I'm talking about the California state. If there are anyone from California or other state tax, and if they have businesses in those states, yes, they can take the PTET credits and the deductions on the return. 199A, flow-through deduction, the QBI deduction, qualified business income, now is permanent. It's 20%. And the state tax exemption bumped up to 15 million, which is great. It's permanent now. The standard deduction also increased. The child tax credit increased to 2,200. And there are the new changes, the tips and overtime. So if you're working in a restaurant, or if you're an employee, or if you're in a business that gives out tips and overtime, make sure you talk to your payroll provider and classify those tips correctly on the W-2 or on the payroll side, so that the employee can take up to $25,000. There's no tax on tip and overtime. There is a new deduction called auto loan interest deduction. Now you can deduct up to $10,000 for US vehicles. But again, there is a phase out. So you really need to be careful of the phase out limits. Adoption credits, there are 5,000. Deduction for seniors. So earlier it was just 1,600 for age 65 plus, and now it's 6,000. But again, it phase out. So everything has a phase out, threshold, income threshold. And when you're doing the planning with your strategist, with your CPA or IRS enroll agent, make sure you go over these and see the impact on your tax return for this year after incorporating all the strategies in the new bill. Let me share one more guide. Give me 1 second. Okay, so here is publication. Okay, let me share again. Okay, here is the publication that I talked about, the tax guide for small business for individual who use Schedule C, right? If you're a sole proprietor or LLC, please download this publication. It talks about your record keeping. It talks about your tax filing situation. It talks about if you have to pay yourself a wage or not. It's a really good guide. So I would highly recommend that. It's publication 334. And once I get all the, details of the attendees, I will send the guide to you all in an email. I want to share one more thing. Okay, so okay. All right, so here is my tax planning for one of my client who was a Schedule C sole proprietor, and I run the projections for him. I saw if he was beneficial on this S Corp or C Corp, right? So if you look at the planning, right, where he was paying himself $250K on as W-2, and then and his Schedule C income was $350, right? On $350, he was paying close to $182 in taxes, like the total income, right? The total taxable income was $620, and he was paying close to $182. Now, when I did the projection and when I understood his goals from the business, I did two projection, S Corp and C Corp. And based on the S Corp projection, I came up with tax savings close to $81,000. And when I did the C corporation, he was saving close to $84. Now, this is just the calculation based on his situation, his individual tax goals that are not defined here. This is just the end product, like what the client really care about is how much is my tax saving? Are you going to back me up in case of an audit? Will I have a strong work paper or not? And this is where, I come up with I basically created a very strong plan for him where I created a reasonable compensation study. I created a retirement account for him and for his employees. I created an accountable plan where he could take a deduction for home office and mileage. And I also included the 2 board meetings as a business deduction. So that brought the income down to 110. If you're assuming why it's K1 here shows 110 instead of 350 because of the strategies. Like if I just take 350 again, it would not create any savings. But yes, but after doing all the strategies, right, after implementing, because strategies are out there, but it's very important that you implement them based on what the code says, and then you maintain those strategies, because strategies changes every year, and so does your tax situation. You will not fall in the same tax bracket next year. So your strategies changes every year as your income and asset change. And yes, I would like to take questions. And sorry if I exceeded the time limit, Katie, but I hope this is helpful. And I will definitely share more information in the email. And yes, let's get to the questions,
Yes,
Katie.
yes, let's get to these. Thank you all for sticking with us here. Ricardo, I provided services and park my work van and run my business at home. What are the limitations of home office expenses as far as, sorry, I have to adjust, as far as bills, expenses, improvements, and mortgage payments?
So if you have a home office, the area of the home office is basically allocated towards your total expenses. Let's say my total expenses, mortgage, utility, and real property tax and other home expenses comes out to be $10,000, okay? But 20% of my home area is allocated to my home office, so I can write off up to $2,000 on my tax return as a home office deduction. And Katie, I'm looking at the chat option. Where are you looking at the questions? Because I'm not able to see the questions on the chat. Is
In
it on
the,
the chat?
it's in the chat. That was the only question that we had. Zoe.
Oh, okay.
Zoe says great
Okay.
info. Yeah.
Yes. Okay. I provide services and park my work van and run my business at home. What are the limitation of home office expenses as far as bill expenses, improvement, and mortgage payment? Yes. So you can definitely, as I mentioned, your home office is where you are. Your home office should not have a bed. That I tell all my clients, do not keep a bed. Your home office should look like an office. They should have a table and a computer and the workspace, because if IRS wants to audit, they can come knock at your door and see your home office just to understand if you are taking those deductions as per the code. And yes, all your expenses, your home expenses and your business expenses are part of your business expenses. That's 100% write-off. But your home expenses are going to be on your home office deduction spreadsheet that will show on your Schedule C of 1040.
Okay, and I don't think, oh, let me see. I believe there was one up here. Deborah asked which book you were referring. What was the name of the book? That
Oh, the
was,
publication 334, Small Business Guide.
oh, and this is the one that you said you were going to send to them in an email, right?
Yes, I'll
Okay.
send other guides as well. Yeah, and I also wanna share my information because I forgot to put the last slide up there. So this is my
Okay.
information. You
And
can book a in-person meeting or virtual meeting. You can look me up on Texas Board. And also you can see my LinkedIn profile. I've done some webinars, in the past as well. And my niche is, tax planning, resolution, fractional CFO services, accounting, and audit support. I don't do payroll, but I partner with ADP to provide better payroll services to my clients. So they take care of the 940, 941s, W-2 for my clients. But I'm able to see if the reportings are done well or not.
Okay, we have Randy Pantoja. I have a mechanic shop, 20 years. It's a C Corp. How can I check if a S Corp is better? My accountant's my brother. He says it's the same. Can you help?
Yes, I can. I would like to have a one-on-one consultation with you to understand the tax returns and the business in general, and then revoke the C Corp election and then switch to a different business entity structure. So really, I want to see how much in taxes you're paying, and then how was it structured, and then what are the compliances behind it, and then complete the tax assessment and advise you accordingly. And my tax assessment, I don't verbally give advice to my client. I back it up with proper report, so that my clients feel comfortable with the codes, the section codes, the PLR, and the IRS guide as well.
And Brian says, I'm an electrical contractor, electrician. Do I pay, oops, hold on, it went away. Hold on. Do I pay sales tax on services provided and materials?
Sales tax, you're an electrical contractor. Now, I want to mention one thing here, especially with the W-9s, right? If you're a business owner and you hire vendors, you're required to send your W-9 to those companies, right? Who are going to pay a 1099 to you at the end of the year. That's really important because they can issue a 1099 NEC to you or miscellaneous income to you, right? But if you are a S corporation, you do not need a 1099. There is no tax form for S corporation income that you're receiving from other customers. But if you are a sole proprietor, partner, you really need to get their W-9s. If you have hired contractors, you need to issue a 1099 to them, right? So you need to get their W-9s and issue a 1099. Now, in his case, where he's an electrical contractor, if he has a permit and he buys material, if he has a resale certificate, he doesn't need to pay tax on purchase. I have a situation where this client was a subcontractor, and the general contractor was supposed to collect and remit sales tax to the state, but he, as a subcontractor, still paid tax on purchases, like he was installing AC units in the general contractor's client location, right? So this subcontractor also had a sale permit. Now, state, if you go on state website, there is a code as well that says you still have a sales tax reporting, but it's $0 reporting. You'll show your total sales, your as whatever income you've earned, but your taxable sale needs to be 0. And you can get the resale certificate from the contractor so that you don't end up paying tax on purchases. I hope that makes sense, and it answers the question.
Okay, we have Janice in the Q&A. Can you have more than one home office in your home?
Tricky question, but yes, you can. But as long as you can show that the home office are used for separate businesses and there are 2 rooms allocated to 2 different businesses.
Okay, we have Sandra. What if there's no profit from business and you have to pay for business expenses from your personal funds? How do you separate funds? Hold on.
Okay. Yeah, I read the question. Yeah, I've read it. So,
Okay, good.
Sandra, if you don't have profit in the business, right? So you would transfer money from your personal account to your business account and categorize it as capital contribution. And then if you have a business bank account, I assume you have an LLC for your business. But if you have a LLC, you'll transfer money from your personal account to your business account, and then pay for business expenses from the business account. Now, if you're not LLC, you're a sole proprietor, you just need to track your expenses that you paid out of your personal.
Okay, so Craig, we've got something from Craig here. To clarify, to consider an S Corp, you recommend the company makes over 50,000 in gross revenue. When it is a service industry, do you subtract payroll? Oops. Do you subtract? Sorry, you guys, it's like I can't.
Yeah, I've read the
Yeah.
question.
Do you
Yeah.
subtract payroll and
So,
owner's draw before factoring in the 50,000
okay,
recommendation?
so owners, yeah, so Craig, very good question. Owner draw is a part of balance sheet item. It is not a part of P&L. Okay, so your gross revenue, let's say you made 100K. Okay, all your expenses comes out to be 40K. Without factoring your payroll, right? Your net income is 60 now, right? 100K minus 40, equals 60K. Now, out of that 60K, yes, you have to pay yourself a wage, and yes, so owner draw is a part of your balance sheet item that tracks your basis, your capital contribution minus your capital distribution, add back your income and deduct the loss, will give you your ending basis.
And that was the last one I see. Do we have any other questions while we have Shalini here, who, by the way, you guys is logging in from India and it's about midnight over there. So thank you for doing this, for us.
Oh,
And I
are there
almost
people
feel,
logging from India too?
no, you, I'm
Oh,
saying
me. Oh,
that
yes,
you are.
yes, sorry. Yes. Okay. I thought like there are some
No,
other
no,
attendees from India too. Yeah, I
no.
mean, I love what I do. I'm very passionate about helping business owners scale in the businesses, and trust me, this is the starting, like getting your ducks in the row and making sure you're compliant from federal and state side is the starting point. But your end goal is to have a smooth exit strategy. That's where this fractional CFO services and the forecasting and budgeting come into play. And you can sell your business and without paying any tax. Like there are clauses in that as well. So I love what I do. I'm very passionate, and I built my book of business very organically. I started with 2 clients and now supporting more than 350 business owners. And see, it's 12:25 a.m. like literally in the midnight, and I'm so like charged up to to go over this webinar and answer questions and help as many people as I can with my knowledge.
We have something here from Terrence. I have a security company that has an open referral program for the public if they refer a company to my security company, and a contract is, sorry, it cuts off for me, y'all. And can you see it, Shalini? Because it cuts off for me. I have to,
Let me see.
this is
It's in
from
the chat.
Terrence.
Okay, yes. So I have a security company. Give me 1 second. Yeah, that has an open referral program for the public. If they refer a company to my security company and a contract is signed between us and the company, they will receive a referral fee. By them receiving a fee, do they have to fill out a 1099 with us? Correct, they do, because technically, it's an income for them, right? So you're supposed to issue a 1099 NEC to them for the referral. Even for realtors, right? I come across with a lot of realtors that do not give 1099 and don't adjust the referral fee in the purchase price of the property, right? Make sure you do either adjust it in the purchase price or issue a 1099. So in your case, Terrence, yes, your referral, even if you have a contract, any income or any expense paid out of your business or earned in the business, right, need to have a proper record keeping, right? And 1099 is a big factor. I can send you a guide on 1099, and I can also send you a guide on who are classified as independent contractor versus employees. That will really help you to give an insight on the filings.
And then we have one last one here from Ricardo. What's the strategy to sell your business
I knew
tax-free?
I I knew this was coming. Okay, so well, there are a lot of strategies. One is the C Corp, where I don't know if you heard about the qualified stock small business stock option QSBS election, and now their limit has increased, right? Where you can take a tax-free capital gain up to 10x of your basis in the business, or $10 million. That's one. And also, like, if you are doing a merger and acquisition, or if you are into a complex sale deal where that deal can be either stock sale or asset sale, that's where these strategies come into play. Now, again, if you want to learn more, I think it's better to have one-on-one conversation, and I can go over your business goals and the strategies that are really fitting well within your business. But yes, there are strategies where you can sell your business tax-free too. But again, it has certain compliances that need to be followed by a professional, and also make sure that the clients understand those compliances and the risk factor involved in it.
And it looks like we don't have any other questions, but we're just about out of time, so that's perfect timing. So I want to thank y'all who are still on here. Thank you guys for sticking with us. This is a lot of information, really essential information for your business. I feel like we need to do a part two, Shalini. I'm going to get with you offline and talk to you about possibly doing a part two maybe in September. So you guys that are still here, be checking your email for the recording that's going to be coming in the next couple of days. For Thursday, probably on Monday, if not tomorrow, probably Monday. And then you'll also get something from Shalini with those guides and information that she was mentioning. And then if we are to have a part two, which hopefully we do, we'll send that information to you in an email as well. So please, if you see anything coming from BBB, be sure and open that up so that you can register. But thank you all for joining us today. Thank you, Shalini, for all of this great information and for getting on and logging on, even though you're on your trip in India. We really appreciate it. And that's all we have. So thank you.
No, you're welcome, and thank you all for sticking with me till the end, and learning a lot from your business and individual tax situation. I'm more than happy to do a free tax assessment for you all, and cover any of your further questions in detail. Yeah, happy to help in any way I can. And thank you so much for the opportunity.
Awesome. Thank you. Thank you, guys. We'll be in touch. Everybody stay
Sure. Have a
safe.
good day.
Bye.
Bye.